This is the Economic Club of Florida, a distinguished platform for discussion of the major national issues of the day.
Good afternoon and Happy New Year. Welcome to the 539th in our series of Distinguished Speaker programs. I'm Bill Moore and I have the privilege of serving as your club president. We have another great program today. Byron Wien, Vice Chairman of the Blackstone Advisory Partners, a subsidiary of the Blackstone Group. Mr. Wien was well received by this club several years ago. Some of you are wondering, what am I still doing on your screen? Well, due to the pandemic, we've had some challenges with our structure, not to mention other challenges. Our plan is to hold an annual meeting virtually to elect a new slate of officers. It's important for everyone to be on the call that is available, as our current bylaws require attendance at the meeting of 25% of our members. Over the next week, please watch for a letter from our chair, Cindy O'Connell, and myself highlighting the club's events of 2020. You will also receive revised bylaws to be approved at the annual meeting, policies and procedures, and the slate of officers and directors for the approval at the annual meeting. I'd like to recognize our sustaining members who provide additional financial support to the club during the year. Please pat yourself on the back and thank you for your support. But I'd also like to thank all the membership for your support over the last year. The board has worked hard to remain relevant to you during COVID times and continue to bring a terrific lineup of distinguished speakers. We have great speakers planned for 2021 and are planning to move back to the Alumni Center, which is now reopened. And we believe it will provide members more comfortable space because it provides a larger meeting space for our members. Our next scheduled in-person meeting will be held at the Alumni Center, and it will be held virtually. Commissioner of Education of Florida, Richard Corcoran, will be our speaker February 23rd. As more people receive the vaccination, we hope you will join us in person. Now I will introduce Club Vice President and Board Member John Bradley. John is Senior Investment Officer at Florida State Board of Administration. John is responsible for securing our distinguished speaker today and will now introduce our speaker.
Thank you, Bill, and good afternoon. It's my pleasure to introduce today's speaker, Byron Wien. Byron is Vice Chairman of Blackstone's Private Wealth Solutions Group, where he acts as Senior Advisor to both the firm and its clients in analyzing economic, social, and political trends to assess the direction of financial markets and thus help guide investment and strategic decisions. Prior to joining Blackstone, Mr. Wien was Chief Investment Strategist for Pequot Capital, and before that served for 21 years as Chief U.S. Investment Strategist at Morgan Stanley. In 1995, Mr. Wien co-authored a book with George Soros on the legendary investor's life and philosophy, Soros on Soros, Staying Ahead of the Curve. In 1998, he was named by First Call the most widely read analyst on Wall Street, and in 2000 was ranked the #1 strategist by smartmoney.com based on his market calls during that year. Mr. Wien was named to the 2004 Smart Money Power 30 list of Wall Street's most influential investors, thinkers, enforcers, policymakers, players, and market movers. In 2006, Mr. Wien was named by New York Magazine as one of the 16 most influential people in Wall Street, and the New York Society of Security Analysts presented Mr. Wien with a Lifetime Achievement Award in 2008. Mr. Wien received an AB with honors from Harvard College and an MBA with distinction from Harvard Business School. He is a member of the Investment Committee of Lincoln Center and the Pritzker Foundation. He is a trustee of the New York Historical Society and chairman of the Investment Committee of the JPB Foundation. We are excited to have Byron back to present his 10 surprises for 2021. So let us welcome Byron Wien, Vice Chairman of the Blackstone Group. Welcome, Byron.
It's great to be here. So let's review the surprises of 2020. I want to emphasize that these are surprises. These are not predictions. These are events that I think have a better than 50% chance of taking place, where the average investor would give them no better than a 1 out of 3 chance. The reason I do it, and I've been doing it now for 36 years, I do it in order to stretch my own thinking and hopefully stretch yours. So last year I missed the biggest surprise of all, the virus that began to hit us in February. But it still turned out not to be as bad a year as I feared. For a long time, I was afraid to look at the 10 surprises because I thought they would turn out so different from what I thought they were going to be as a result of the virus. But I got a number of them pretty nearly right. I want to emphasize, I don't do it for score. I do it to try to stretch my own thinking and hopefully yours. So I thought we'd have a difficult economy, but we avoid a recession. Well, we clearly had a recession and a bear market, but it only lasted a few weeks. I thought the Federal Reserve would cut interest rates, and they did. I thought the Democrats would take the Senate, and I thought inequality and climate change would be big issues. Got that right. I thought there'd be no phase 2 deal with China. I thought the prospect of a self-driving car would be pushed further into the future. I thought that Iran would be more hostile than it turned out to be. But it did step up its nuclear development program. I thought the market would get to 3,500, and it actually got above 3,700. I thought the big tech companies would get more scrutiny, and they did. I thought that there would ultimately be a Brexit deal, and there was. I thought interest rates would rise, and I was wrong about that. And I thought the Boeing 737 would fly with passengers. And at the end of December, American Airlines instituted a flight between Miami and New York. So it wasn't as bad a year as I feared. But now let's focus on the surprises of 2021. These were all issued on January 4th. The first one was sort of whimsical. I thought Donald Trump would leave office. He would plan to start a television network, and he would be the lead program, a program called The Chief, which weekly would interview CEOs and heads of state with management styles like his own. That seemed appropriate on January 4th when the surprises were announced. But on January 6th, when the Capitol was besieged, this one no longer seemed as relevant, and whimsy didn't seem appropriate. Number two, I thought that one of the top, or maybe the top diplomatic priority for President Biden would be to try to establish a harmonious relationship with China. China is the number 2 economy in the world today. We are still the number 1, but China will become the number 1 at some point in the future. And I don't think it makes sense for the number 1 and 2 economies in the world to be at odds with each other. So I'm hopeful that a more workable relationship will be able to be achieved. So far, both Biden and Trump had negative rhetoric during the campaign about China. So I think it's a turnaround. And there's also the issue of whether China needs the United States. They had real GDP growth in 2020 of 2%. They're likely to have positive growth of perhaps as much as 8% this year. They got the virus under control, although it's had a resurgence since then. But they may not need, they might feel that they need to have a rapprochement with the United States. So that one is more conjectural, but I hope it's achieved. Number three, I think we're having a trouble getting the vaccines distributed and taken, that off to a slow start. But Biden has committed to having 100 million vaccines. That's a third of the population, probably half of the working population. He wants to get 100 million into people's arms by the end of the first 100 days of his administration, which starts tomorrow. So we'll see whether he's able to achieve that. But if he is, we may reach the third surprise, which is that we would be back to some form of normal. I think there are going to be some secular changes, but we'll be back to some form of normal by Memorial Day. That would be a real surprise. In order to fly or attend a sports event or any group event, you'd have to show proof of vaccination. But the Summer Olympics would be, which were postponed last year, would be held as scheduled for this year, and people would be able to attend as spectators. Number four, the Justice Department would ease up on Google and Facebook. They still would put surveillance restrictions on, but their attempt to break them up into separate companies would be abandoned. The decision would be based on the fact that Facebook and Google actually have improved the quality of life for all of us, and their acquisition policies are not reducing the startup of a number of companies in the social media space. I would say of the surprises fall into two categories. Category one is the ones that are truly contrarian. This is one of the truly contrarian surprises. The China surprise is truly contrarian. And at the end, the surprise that the dollar is strong is truly contrarian. The others are in the direction of the consensus, just more extreme. For example, the economy developing momentum of its own. Number five, real growth being 6%, unemployment falling to 5%, and beginning the longest economic cycle since the one that ended the pandemic. That's in the direction of the consensus, just more optimistic. Number six, the Federal Reserve and the government openly embrace modern monetary theory. They feel as long as we can print our own currency and we don't suffer any inflation or serious inflation, that we can continue to stimulate the economy. That's modern monetary theory. And we've fallen into it whether we wanted to or not so far. And the new $1.9 trillion program is a good example of that. So they're not admitting to modern monetary theory, but it looks like that's what we have. Number 7, on energy, I think the price of oil is going to rise to $65. We're a long way from that now, but it looks like we're headed higher. If I'm right, and the economy opens up at the end of May, there are going to be more people driving, more businesses operating, more restaurants opening, and there's a good chance that the demand for energy will increase. Number 8, I think the stock market will broaden out. It's already been strong, but I do think that the market is vulnerable to a correction. But I think after the correction, which I think will occur in the first half, the market reaches 4,500 this year. It's already off to a strong start, but I think we're vulnerable to a correction in the first half. I think investors are always prepared for a 5 or 10% correction. And if we have one, it'll go further than we originally thought. That's what I'm worried about. But I think the second half, when the economy is strong as a result of the recovery, I think the market will be strong and it'll end the year at 4,500 or thereabouts. Number 9, I think we are going to see some greater inflation this year. And I do think the 10-year Treasury yield will get to 2%. There are a lot of people at 1.5%. It's already over 1%. And I think it'll get to 2%. But while I think we'll have greater inflation, I don't think it'll be serious. And number 10, almost everybody thinks the dollar is headed lower. I think the dollar is headed higher because as the market recovers in the second half, as the economy does well, it is my belief that we're going to have a greater interest in investing in the US, and that will cause it to show greater strength. Now, every year, I always have a few also rants. These are surprise ideas that I don't think are as good as the 10 I chose, or I can't bring myself to having 50% conviction that they're going to take place. I believe that each of these ideas is likely, and I take $1 million of my own money and invest it in ETFs that are related to the surprises that are investable. So the first one is that cyber attacks from Europe and Russia are become more prevalent, but we're already seeing that, so that's in the news, so it wouldn't be a surprise. The second one is that Tesla acquires a conventional automobile company to get the distribution, but the people who are closest to Tesla tell me there is no way they would do that. They're doing very well on their own in being able to distribute their automobiles, and there's plenty of demand, not only in the United States and Europe, but also in China. And number 3, this one is related to the first one, and just as the first one isn't as whimsical as I thought it would be, this one, which has Kim Jong-Un appearing on Trump's television program and thinking that before he gets on the program, he'll announce that he has a nuclear-tipped warhead capable of reaching Los Angeles. What I have him saying is that he agrees not to test it on the program, and Trump says he's the best negotiator. That may have seemed appropriate at the beginning of the year, but with all that's happened in Washington since then, I don't think it is appropriate. So those are the 10 surprises and the 3 also rans. And now I'd like to take any questions from either the audience or from the host. Bill, do you want to field the questions, or are we getting questions from the audience?
So Byron, first, thank you so much for your presentation. I know we always look forward to the unveiling of your surprises each year, and we definitely appreciate you sharing those with us this year. We do have some questions from the audience, so perhaps I can moderate and ask the questions, and I would also encourage our members to continue to use your question button on the internet to ask Byron questions. So Byron, I'll start off with the first question, which was around inflation. So inflation was a large concern for a lot of folks following the global financial crisis, and it never materialized. Inflation doesn't seem to be a concern today. So should that one scare us? And where might an inflation surprise come from this time around?
Okay, if you look at the situation that we're in right now, I don't think we're going to have significant inflation caused by rents. I think a number of us have grown comfortable working remotely. I think that's going to take pressure off office space, and a number of people are moving out of the major cities to lower cost areas because they can work remotely. So I don't think we're going to see pressure on rents. I don't think we're going to see pressure on wages. We have 10 million people unemployed, and so I think wage pressure is not going to be serious. And as a result of that, I think we're not going to get it from that sector of the economy. The one place we could get some greater inflation is commodities, particularly if I'm right, if oil, the most important commodity of them all, goes up to $65 in price. So that's the one place where we could get inflation. I think we're starting to get a little of it now, but as I said, I think we're going to have limited inflation, but I don't think it'll drive the 10-year Treasury above 2%. So I look for more inflation, but not serious inflation, and the lack of pressure on wages and rents is the reason it won't get out of control.
Thank you. So our next question from one of our members is, given that the new Secretary of the Treasury, or at least the presumed new secretary, Janet Yellen, was a past Fed chair, I think this is only the second time that's happened in history, might we see, and might there be any surprises from increased coordination between monetary and fiscal policy going forward?
Well, I think we're already seeing it. I think monetary policy remains accommodative. I think fiscal policy is this new $1.9 trillion program is very generous. So that's going on. So right now we're seeing a federal government that is very concerned about the future of the economy and the current state of the economy. And we're seeing it at both the monetary policy and the fiscal policy level. We're doing everything possible to help the people in need in American society, and that's why I think there's been a de facto falling into modern monetary theory. we have a government trying to do everything it can to get the economy going again. The one thing I worry about, Bill, is that we're dependent on fiscal and monetary policy. We're not developing any natural momentum on its own. We probably need everybody to be vaccinated, or at least all the people who want to be vaccinated, in order to achieve that. But I'm hopeful we're going to get that. Right now, only about half the people say they're willing to be vaccinated, but we really need to get about 70% of the people vaccinated with a 90% effective ratio, and that would take us to 63, plus the number that have already had the disease and are immune as a result, in the number who have had it and don't know they've had it. And so that'll get us to 70%. That's pretty close to herd immunity, and that would put the economy back on a strong footing. But we need to get these vaccinations distributed and taken by people in order to get to that point.
Yep, thank you. Byron, our next question comes from one of our members and past chairman, Ben Watkins. His question is, do you think that there are ultimately adverse consequences to the increased debt advocated by modern monetary theorists?
Well, I certainly did a decade ago and 2 decades ago. I was definitely not on the modern monetary theory bandwagon. And I still am nervous about it. I don't think we're going to pay back the debt. But I am worried that the accumulated debt is going to lead to higher interest rates and more inflation. I think we're going to continue to be able to roll over the debt, that people will buy it, but they're going to require higher interest rates to attract their investment. So I don't think we're going to get away with just being able to print currency and continued low interest rates. I think we'll enjoy low interest rates for the next year or two, but I worry a year or so after that we're going to be in somewhat greater trouble. I think you're right to raise it, but I think we're okay for the next year or two. But beyond that, I think the cost of maintaining the debt is going to be greater. But I don't think that's going to be a near-term problem.
Yep. Thank you. Our next question is a follow-on to the first one regarding inflation, around the new minimum wage that was passed with I think 15 states passed increases this year in their minimum wage. So do you see this leading to an increase in inflation?
Well, I think it will put some pressure on inflation, but a number of states already have a $15 minimum wage. And there will always be some people who are willing to take a job and work below that. But there are a number of institutions, restaurants, other cleaning jobs, hospitality jobs that have paid below the minimum wage of $15. And some of them will continue to do so. But I think it is inflationary, but in a very mild way. I think a lot of people already make more than the $15 minimum. So I think it'll contribute mildly to inflation. But as I said earlier, I think mild inflation is something we're going to see this year. And that's going to push the 10-year Treasury up to a 2% yield.
Thank you. Our next question is, So the gap between the haves and have-nots has been exacerbated by the COVID pandemic. Do you see this as any kind of a systemic concern? And is this kind of gap economically sustainable?
I think that this is one of the most serious problems we're facing in the United States. About 40% of the people in the US are able to work remotely. They're drawing their paychecks, they're getting their job done. About 40% have to go to work every day and show up at their jobs. And about 20% are either looking for a job or unemployed. So that part of the population is trying to put food on the table, is counting on government support to do that. That portion of the population is having trouble paying the rent. So the cleavage between the haves and the have-nots is growing in the pandemic rather than being reduced. I think this is one of the most serious problems facing the United States. The only way we can really deal with it is growth, but the growth that we had in the past decade really exacerbated the problem. The rich got richer during the pandemic, and the poor suffered more. So it went the wrong way during the past year. So we've got to get the economy back to normal. We've got to get the economy self-sustaining, not dependent on government support. And we're not doing it yet. So we've got to get there as soon as possible. But I agree that you're right to focus on it. And we've just got to provide more jobs for people. We've got to improve education. But those are long-term problems that are hard to turn around. Education is the key to doing well. I think we need an apprenticeship program where people who don't have a college education get trained for lucrative careers in the trades as they do in Germany. We just have to focus more on inequality as a problem, and we have to do everything possible to close the gap. We've talked a lot about it over the past 50 years, but it's still a problem for our society. And we've lost ground in the past year, and we've just got to try to make up some of that lost ground. But I agree that it's one of the most serious issues facing the United States right now. It's followed by climate change. That's another serious problem which we're going to have to deal with. And we need to improve our infrastructure. So education, inequality, and infrastructure have got to be the focus of the Biden administration in its first 100 days in office.
Yeah. Thank you. We've received a number of questions around China, so maybe we can switch our focus there. And so I think, we all see China striving to become the world's dominant economic power, whether it's through initiatives like the Belt and Road Initiative or Made in China 2025. They seem to be well on their way. And so a question from one of our members is that, do you believe normalizing our relations with China, it will be good for our country, and should we?
I definitely think it'll be good for our country. I definitely think we should. As I said during the earlier narrative, I'm not sure China is as anxious to restore a harmonious relationship with us as we are, because they think they're doing very well on their own. But I think it's imperative that we do it. We already buy half $1 trillion worth of goods from China and ship $130 billion worth of goods to them. So they're an important trading partner for both countries. They have 4 times the population we have. They're making progress in technology. So I think they're going to be the largest economy in the world, and I don't think we should have a adversarial relationship with them. So I think it should be the #1 diplomatic priority for the Biden administration, and I hope Anthony Blinken will undertake it in his first days as Secretary of State. My concern is that China doesn't want it as much as we do, and that therefore they're not amenable to some of the agreements which we think are important, like the protection of intellectual property, being willing to do joint ventures with us on a level playing field basis. So I think it's going to require great diplomatic skill, but I think it's worth the expenditure of that skill because I think it's something that is necessary to achieve. But it isn't a slam dunk by a long shot.
Yep. And Dagan, I think we have time for one more question here, which is just around the U.S. dollar. And so do you envision or see the U.S. dollar ever losing its status as the world's reserve currency? So might the Chinese yuan, might that take over?
Well, the advantage of the dollar is there's so many of them outstanding. It's so convenient to deal with it, whether you're in a legitimate or an illegitimate business. I don't think the renminbi, where the highest note is 100 renminbi, I can see the renminbi being part of a basket of currencies, but I think the dollar is going to be the reserve currency for an indefinite period. I won't say it can't be replaced. Maybe 10 years from now, cryptocurrencies will challenge it. But right now, I think the dollar is pretty secure as the reserve currency for the next few years. It's just so convenient to deal in dollars, and that's being experienced around the world. So right now, I think the dollar will remain the reserve currency for at least the next several years, and perhaps for an indefinite period.
Thank you, Byron. Back to Bill Moore here. I want to thank you on behalf of the Board of Directors and our membership of the Economic Club of Florida for your insightful presentation today and your time. And we really appreciate you taking the time to do this and look forward to a prosperous 2021.
Go back. Well, it's always great to do it. I've got the eagle from the last time I presented in person in Tallahassee. I look forward to presenting in person next year. I hope we'll all be back to work and on the job, and I hope I'll be traveling again. I've been cooped up here in my weekend home for 9 months. I've been in the city a few times, but not on a regular basis. Florida is an important partner of Blackstone, and I look forward to seeing you all in person in early 2022.
Right. Thank you, Byron. Have a good day.